Yes, indeed. Jedi Options, Boomerangs today. Listen, you get a sneak peek. You don't know what's on the DSM list. I'm going to tell you one of them. Okay, it's Schlumberger, SLB. SLB. Just to emphasize what Matt said about DSM that makes it interesting is these are usually somewhat cheaper stocks. And the reason that's kind of a qualifier is because if you're going to be doing strategies like naked puts, like covered calls, the cost of the trade is a function of the stock price. Lower stock price, lower cost. And typically lower cost translates into a higher return on investment, right? So these are cheaper stocks and they're super liquid, which makes it easy to structure trades like naked puts and covered calls and flip back and forth. And to his point, there's more volatility. This is the anti-silver. SLV, not a lot of juice selling puts. The stocks in DSM typically have a fair bit of volatility on average. The reason SLB I thought would be a good example today is twofold. Number one, we talked about crude oil today, having a nice little potential trend reversal, showing some strength after weeks and weeks of weakness. And SLB of its own right has a good looking chart. This did not sell off as much as the energy sector. The energy sector still has not kind of reclaimed the range it was in before it broke down. SLB has. In fact, it really broke down for one day and then came right back, and it's now close to its prior high. So you're seeing strength. You can call today a breakout over this trend line. You can call it a breakout. It was yesterday over a pivot. You're seeing strength here. So I like the chart. I like the chart. How do you play it? One of the things I like about the concept of selling puts as well as covered calls, we usually pair these together, naked puts and covered calls. The reason they're pairs is there's actually a couple of reasons, right? So one reason is because a naked put and a covered call are synthetics. They're equivalent positions. They look identical when you use the same strike price. But usually you don't use the same strike price. When you're selling puts, you're selling strikes below the current stock price. When you're selling calls, you're usually selling calls above the current stock price. And the interesting thing about this, all we're trying to do is just enhance stock ownership, right? And there's a lot of different ways you can use options. Some people view the options market as a casino, right? You're just speculating, you're just gambling, you're just buying lotto tickets. You could do that if you wanted to. Covered calls and naked puts are not that. It's actually, I think, far from casino gambling, those kind of pictures. You're enhancing your return when you own stock, right? I'm just trying to dial up the return. I'm trying to reduce the volatility of stock ownership. And in doing that, it's a less risky proposition. You're using options to smooth out the equity curve or the movement of your position. You're using the options market maybe partly for its original intended purpose, which is to hedge and reduce risk and be smarter about the way you invest. And simply put, when you think about a naked put, we are getting paid to buy a stock at a lower price. Okay, we're going to get paid. I'm going to get paid to do something I'm probably going to do anyways, right? I'm with a covered call. I'm getting paid to sell high. Okay, which is something I like to do with stocks. And so all a boomerang is a boomerang. You think of the visual of going out and coming back and going out and coming back and kind of this cycle. All you're doing with a boomerang is you're just rotating from selling puts to then selling covered calls, to selling puts to selling covered calls. And sequentially, you're just getting paid to buy something at a lower price month after month. And then eventually you'll have to make good on that obligation. You'll buy the stock, and then you're getting paid to be willing to sell it at a higher price month after month after month. And when you got to make good on that obligation, you unload the stock. And then you just go back to selling puts again. So it's this kind of lovely cycle here. But every time you sell a put or sell a call, you get paid, right? You get paid. Well, here's where I'm at in the cycle. I don't own SLB, right? I didn't know SLB was going to be on Dirty Sexy Money, but now it's on my radar, and I'm thinking, all right, let's play around with this. And typically, you start by selling a put, right? Got to buy low before you can sell high. So that's kind of step one. So what we're going to do is, if this is the chart of SLB and it's at, I can't even remember the price. Let's say it's at $40. It's actually higher than that. Let's say it's at 50. I am going to sell a put. I'm going to sell a put down here that obligates me to buy it at a lower price. And I'm going to get paid some money. Okay. So all I really have to do is decide what price am I willing to buy the stock at? And is there enough money in it for me? Right? Is there enough money in it for it? Because I could be like, well, dude, I'll buy the stock if it goes down to $5. I'm totally a willing buyer down there because it will have been a 95% decline. Well, no kidding. Nobody's going to pay you any money to take that bet because the odds of it going down to 5 are just so low, right? So you have to balance the desire for getting a deep discount with the willingness of accepting a certain payout. And we have some guidelines for that. So let's take a look here. Let's take a look. As I look at the stock chart, again, I've anchored on these resistance zones, these breakouts. I think, listen, if the breakout is legit, where should the stock not come back down to? You've got pretty good support around 47, 47.50. If this really is a breakout, okay, and bulls really do like Schlumberger enough to have driven the stock far higher than its sector, it shouldn't go back down to 47.50. Okay. And if it does, and it's actually a company I like and I want some exposure to energy, then maybe I'm a willing buyer down at 47.50 anyways. So I would like to get paid for my willingness to accumulate shares of Schlumberger in the next 30 days at 47.50. Okay. Now, listen, if they're going to pay me 5 cents, it's not worth it. Right. So for us, usually the rule of thumb is I got to get around a 10% return to make this interesting with a low delta. Okay. So I got to run the numbers and see if it works. All right. I like it based on the chart, but let's see if the numbers are there. Because if this is silver, it's bound to disappoint. Right. I mean, I've tried to set this up in SLB all the time, and I go to the premium and I'm like, well, there's no money, so I can't do it. But in this case, we've pre-prepped this, so I know there is enough money. So number one, from a delta perspective, this gives you a sense of your likelihood of success, your probability of profit. We like to sell a delta around 20 or less. Quite frankly, the lower, the better. In this case, we're going to be able to sell around a 16 delta. That means there's about an 84% chance that this put's going to expire worthless. And if it does, I win. So I got an 84% chance of success. It's about 60 cents. First, another thing to notice is the tight bid-ask spread. 3 cents, super liquid. Okay. So I'm going to sell the 47.50. Let's say I get $60. Okay. Now I know math, a little bit of math. I know that if it's $60, I don't want the cost to be more than about 600 because that's what translates into a 10% return. Well, Thinkorswim's nice. They tell me ahead of time. You hit confirm and send, and they tell you the buying power effect. Okay. $500, $494. That is the initial margin required, the initial collateral or cost of the trade. So if I make $60 on about 500, that's above a 10% return. It checks the box, right? If this was silver, I'd be like getting $60 on 1,200 or something, it'd be like a 5% return. So this is why it's a DSM. That's why SLV is not on the DSM list, because it doesn't give you these kind of numbers. Schlumberger does.